Welcome to the Explainer. Okay, let's be honest. Have you ever felt like your investment strategy is, well, more like a hopeful wish than an actual plan? If that sounds familiar, you're in exactly the right place. Today, we're going to build a real investor's playbook, piece by intentional piece.
Right. We've all heard this classic line from Warren Buffett. It sounds so simple, doesn't it? But you know as well as I do that actually putting this into practice, well, that's the hard part.
A lot of the time, it's because there's no real plan. People are investing based on a hot tip they heard, something some influencer posted, or just pure emotion. They see a stock that's tanked, and that little voice in their head goes, "Oh, it has to bounce back." But is that a real reason to risk your money?
So, the way to combat that is to develop what our source material calls an investment thesis. Now, this isn't just some fuzzy hope. It's a solid, well-thought-out argument for why you're putting your hard-earned cash into a specific company. It's your personal why.
This really gets to the heart of the investor's dilemma, right? How do you take advantage of that short-term market craziness without getting totally burned? And that brings us to the very first play in our playbook, a strategy for dealing with market overreactions.
It's called a swing trade. And the thesis here is pretty straightforward. You found a great company that's been hammered by some temporary bad news, and you believe it's going to swing right back up once the market snaps out of it. This isn't a forever hold, it's a specific targeted opportunity.
And what's absolutely crucial here is discipline. This is not an open-ended bet where you just wait and see. You're specifically looking for that recovery to happen within about 6 to 12 months. If it doesn't, that's a huge signal that your thesis might be wrong, and it's time to reevaluate, not just cross your fingers and hope. So for a real-world example, our source material points to a successful swing trade in Meta back in 2022. The thesis was that Wall Street was just completely overreacting to Zuckerberg's spending on the metaverse. So the investor bought in, waited for the panic to die down and the stock to recover, and then sold. Right now, a similar thesis is in play for PayPal, a bet that new management can get that ship turned around.
All right, so swing trades are for capitalizing on the short term. Now let's talk about building the real, long-term core of our portfolio. And this is where we bring in two very different but equally important categories, what we'll call staples and moonshots.
First up, let's talk about staples. I want you to think of these as the reliable, steady workhorses of your portfolio. These are the companies where you have a really strong belief that they can just consistently grow their business over the next few years.
Now with staples, your mindset and your time horizon are totally different. This is not a quick flip. You're investing for 1 to 5 years, and it's based on a real conviction that the company has a lasting competitive advantage. Better tech, amazing leadership, or a product that people are just obsessed with.
Some great examples of staples could be a company like NVIDIA, where the thesis is based on its ongoing dominance in AI chips, or maybe Nubank, with a thesis built around its huge growth potential in the Latin American banking scene. These are solid, established businesses that still have a lot of room to run.
Then, on the complete other end of the spectrum, you've got your moonshots. Look, these are your lottery tickets. They're your high-risk but hopefully super high-reward bets. You're putting small amounts of money into unproven companies, hoping you've found the next Amazon or Tesla before anybody else has a clue.
And this is where you can really see how it all balances out. Staples are there to provide that steady growth from proven business models over the next few years. Moonshots, though, that's all about finding truly game-changing innovation, and you're looking out 5 years or more. The risk is completely different, and they play totally different roles in your portfolio.
Okay, so we've got our short-term plays, we've got our steady growers, and we've got our long-shot bets. But what's the glue that holds it all together? All of these strategies have to revolve around a central, unshakable conviction, and that is the true heart of the portfolio.
This brings us to the very center of the investment playbook. It is the final, and I would argue the most important category of all, the super staples.
Super staples, they're just in a league of their own. This is so much more than just owning a stock. It's about having such a deep, long-term belief in a company's vision and their ability to pull it off that you basically feel like a business partner. The whole thesis is that these companies are on a path to become some of the biggest in the world within a decade.
And the commitment level here, it is total. You just invest as you earn. There's no set budget. You know this company inside and out, the products, the CEO, the company culture. You are prepared to hold for 10+ years, and you follow the business with an almost obsessive level of detail.
So for the investor in our source material, Tesla and Palantir are the core super staples. These are the companies he knows most intimately. But here's what's really cool. This isn't a static label. A company like NVIDIA can actually start out as a staple, and then as your conviction grows and grows, it can evolve into a super staple at the very center of your entire strategy.
Okay, so how do all of these different pieces, the swing trades, the moonshots, the staples, and the super staples, how do they all actually fit together? Let's take a look at how you can build them into one cohesive playbook.
Here's a sample allocation based on our source. And what I want you to notice is that a full 50%, half the portfolio, is dedicated to those highest conviction super staples. Then you have the staples making up another 30%, with smaller slices for the shorter-term swing trades and the really high-risk moonshot.
But look, the main takeaway here is not to go out and copy this exact portfolio. It's to use this framework to build your own. For every single investment you make, you should be able to clearly define your thesis, categorize its role in your portfolio, set rules for it, and then follow it with the attention that it deserves.
So, before you make your next move in the market, just ask yourself this one simple question. What's my thesis? Seriously, having a clear answer to that is a difference between investing with a plan and just rolling the dice. Thanks for joining this explainer.